So good evening all once again. So we will first continue with where we left yesterday. Question number 3 and question number 6. These are the two questions which were pending of AS5. We'll complete that. And one more point, AS7 we will be completing on Sunday. So Sunday what I'll be doing is the early bird students will be waiting till 8:30 at night, whatever is your timing. The regular students, I will leave them around 1 hour before. So regular students, I will pack them up at 7:30. So regular students should leave the session at 7:30. So 7:30 to 8:30, last 1 hour, we will be keeping for AS7, where we have to cover 3 questions and the disclosure part. So 1 hour, 15 minutes, whatever will be required, I will keep it at the end. Say, for example, 7:15 to 8:30, the last 1 hour, 15-minute session will be for only the early bird students to complete AS7, and the rest all the regular students will pack up at 7:15. So Sunday we will be completing. Fine. So today and tomorrow we are not talking about AS7. Sunday I will definitely complete AS7. Right, for the early bird students. Now let us start with question number 3. What is question number 3 saying? X Company Limited signed an agreement with its employees union for revision of wages in June 2012. So in June 2012, they decide that the wages will be revised. Okay. The wage revision is with retrospective effect. Retrospective effect from 1st April 2008. So almost they are increasing the salary of last 4 years. From last 4 years, they are increasing the salary. And yesterday only we learned that if there is a retrospective increase in salary or wages, that is an exception to prior period. Means it is not an error or an omission. It is not a prior period item. Right? So now we have to decide whether this is extraordinary or ordinary item. Right? So my next question, sir, it is only wages. So is wages an ordinary or extraordinary item? Sir, it is ordinary item. Correct. So here the wage revision which is taking place is technically an ordinary item. Okay, let us go ahead. The arrear wages up to 31st March 2012 is amounting to 80 lakhs, and arrear wages for the current year, that is from 1st April 2012 to 30th June 2012, that is the date of agreement, means on 30th June agreement was signed. So for the current year, 3 months period we are increasing the wages, and for last 4 years also we are increasing the wages. So the liability of last 4 years retrospective is 80 lakh rupees, which is given over here. And in the current year, for April, May, and June, 3 months we are increasing the wages, that is 7 lakh rupees. So technically, 87 lakh rupees is the total arrear wages. 87 lakh rupees is the total arrear wages, right? And they have given us the bifurcation. Means for the period from 1st April 2008 to 31st March 2012, 80 lakh rupees, that is till the last year, last 4 years. And in current year, there are 3 months where we have done the retrospective increase, that is 1st April 2012 to 30th June 2012, that is 7 lakhs. But technically, total 87 lakh rupees is the retrospective increase in the wages. Decide whether a separate disclosure of arrear wages is required. Now, can I say a separate disclosure is given only if it is an exceptional item, that is ordinary exceptional, or it is an extraordinary item, or it is a prior period item? Can I say in this question, it is not an extraordinary, not a prior period item, it is only an ordinary item? But 87 lakh rupees, 87 lakh rupees amount is abnormal, amount is big, na? 87 lakh amount is big, right? So if this amount is bigger, means the size of the amount is too large for the enterprise, then definitely a separate disclosure may be given. But if 87 lakh rupees is nominal for the enterprise, now see, whether it is nominal or not, it is not given in the question. Right? It is not given in the question whether 87 lakh is material for the enterprise or not. Right? So we have to like finalize whether this is material or not for the enterprise. Because if it is material, a separate disclosure may be given. But if it is not material, no separate disclosure is required. Right? So I would conclude that as per the question they are asking whether a separate disclosure is required, I will give my answer as no, it is not required. But I will give a second opinion also. If this 87 lakh is material, then a separate disclosure may be given. Right? So let us have a look at the solution. What it says, it is given that revision of wages took place in June 2012 with retrospective effect from 1st April 2008. The arrear wages payable for the period from 1st April 2008 to 31st March 2012 cannot be taken as an error or omission in the preparation of financial statements of earlier years. Right? And hence this expenditure cannot be taken as a prior period item. Now, why they have given a bifurcation? Because 31st March 2012, the year ends, and April, May, and June falls in the current year. So current year items are anyhow not prior periods. And this 80 lakhs belongs to the last 4 years. That is why they are saying that this 80 lakhs are not prior period items, because they are not errors or omissions. That is what the first paragraph says. Then they say additional wages liability of total 87 lakh rupees, that is from 1st April 2008 to 30th June 2012, should be included in the current year's wages. And it may be mentioned that additional wages is an expense arising from the ordinary activities of the company. So entire 87 lakh is an ordinary item. Although abnormal in amount because 87 lakh is too high. Such an expense does not qualify as an extraordinary item. So yesterday, if you remember, I said that to decide whether it is an extraordinary item or not, you have to check that item with the nature of your business. Right? Amount is not relevant. The occurrence, whether it is non-recurring or recurring, that is not relevant. What is more relevant is the nature of your business and nature of your transaction. If the nature of the transaction is completely different from your day-to-day operations, then it can be considered as a extraordinary item. Even if then it happens twice or thrice a year, no problem. So the occurrence is not that relevant. What is relevant is what? The nature of the transaction. So however, as per AS5, net profit or loss for the period, when items of incomes and expense within profit or loss from ordinary activities are of such size, nature, or incidents that their disclosure is relevant to explain the performance of the enterprise for the period, the nature and amount of such items should be disclosed separately. So if you understand this, we are talking about if it is an ordinary item, but the amount and the nature is relevant for the enterprise. To explain the financial statements in a better manner, a separate disclosure may be given. Right? And finally, however, wages payable for the current year, that is from 1st April 2012 to 30th June, that is 7 lakhs, cannot be a prior period item because it is obviously of the current year only. And current year items are never prior periods. And hence need not disclose separately. This may be shown as current year's wages. So technically, the 80 lakhs for the last 4 years and 7 lakhs of this current year, entire 87 lakh rupees cannot be treated as a prior period item. Right? They are not even extraordinary item. They are purely items of ordinary activities and hence no separate disclosure is required. But only one point we have added up, as per AS5, even if an ordinary item whose size and nature is important to be disclosed separately to make people understand about your financial statement, disclosure can be given. So this is your full solution for question number 3. I hope you're getting this point. Please take a note of this. Please note it down. Yes, group 1 students will not have class because AS4 is again group 1 only. Yes, group 1 students will not have class today because again it is group, what I say, group 2 standard, AS4 also. And tomorrow also we are having AS20 to be covered. And tomorrow AS20 we are starting EPS, earnings per share. That is a practical accounting standard. So tomorrow also it is a group 2 standard only. Question number 3. Question number 3 is over. I'll be starting with question number 6. Please take a screenshot of question number 3, whosoever asked. I'll go for question number 6. See, yesterday only I gave you one page where it is written, and even in my first lecture, the introduction lecture also, I've given you which AS will fall in group 1 and which AS will fall in group 2. So from my side, I've already cleared all these things. So I don't know whether you have written down those things or not, or you attended the first session or not. But in my first lecture only, I already gave you the bifurcations, like which AS fall in group 1 and which AS fall in group 2. So I've already told. And one day prior, I'll be telling you that which AS we are doing. So with the group 2 students, I've already informed your branch also, like the group 2 students will now attend directly on Sunday, because tomorrow also we have to go on with AS20 EPS only. So they will be attending directly on Sunday. I will be going for question number 6. Just a minute. So, question number 6. It's a nice question. Please focus. What it says: closing stock for the year ending on 31st March 2013 is 1.5 lakh. So as on 31st March, you have valued your closing stock at 1.5 lakh, which includes stock damaged in a fire in 11-12. So technically, some stock was damaged last year, and obviously, since it is damaged, it might not have been sold. So it is still lying in your godown. And in this 1,50,000 valuation, the value of the damaged goods is also included. On 31st March 2012, that is last year, the estimated NRV of the damaged stock was 12,000. Now, please understand one thing. Can I say last year stock was damaged due to fire? Right? And last year's NRV was estimated at 12,000. Now, can I say last year the NRV would have been lower than the cost? Because these are damaged goods. So technically, you will not fetch the cost. Yes or no? Right? So can I say last year, if you recorded them at 12,000 NRV, assuming not, the cost will be definitely greater than the NRV. There is no need to assume also. So can I say loss would have been arisen in the last year because of write down in the value of inventory? Right? So let us take the cost was 20,000. Assume the cost was 20,000. And NRV after damage is 12,000. So can I say you have to write down the value of inventory by 8,000? Yes or no? Inventory you have to write down by 8,000 rupees. And can I say this is a loss? Technically, these losses are called as ordinary exceptional items. Ordinary exceptional items. If you remember yesterday's point, see, these are ordinary activities, and in ordinary exceptional items, the example was write down of inventories to NRV. Write down of inventories to NRV are generally what? Exceptional. That is ordinary exceptional item. But my question is, this write down is because of what? This write down is because of what? Fire. So can I say it is technically more of loss by fire? Loss by fire is exceptional or extraordinary? It is extraordinary. So technically, last year, when the loss was recorded, it will be clearly recorded as an extraordinary item in the profit and loss account. I hope you're understanding my point. Right? I hope you're understanding. So last year, we have just taken as an example that cost was 20,000 and NRV is 12. So last year, technically, if this 8,000 was a loss, it would have been recorded as what? As a extraordinary item in the books of accounts. Correct? Okay. The revised estimate of the net realizable value of damaged stock included in closing stock at 12/13 is 4,000. Means, sir, last year's NRV was 12,000 and current year still it is not sold. So NRV has further fallen down and it is estimated to only be 4,000. And this 4,000 is a part of this 1,50,000. Right? This 4,000 is included in this 1,50,000 of total goods. They are asking find the value of closing stock to be shown in the profit and loss account for the year 12/13 using the provisions of AS5. Now, please understand one thing. 1,50,000 is the value of total goods. Right? In this, 4,000 rupees is NRV of damaged goods. So when you subtract this, 1,46,000 is you get is called as the value of inventory. Because, sir, technically in your P&L account, only the good items should be shown and the abnormal items of goods should be shown separately. So in your P&L account, your closing stock will be shown at 1,46,000 and the 4,000 which are damaged goods will be shown separately. Right? Now, further one more point to be noted. Now, can I say NRV in the opening was 12,000 because last year's closing means current year's opening? Yes or no? But at the time of closing, NRV is only 4,000. So can I say estimate changed? Last year estimate was 12,000, current year estimate is 4,000. So there is a change in accounting estimate. And the effect of change is 8,000 rupees. Yes or no? Because the NRV opening is 12,000. NRV in the closing balance is only 4,000. So can I say there is again a difference of 8,000? And this is a loss again. So this loss will be what? Ordinary or extraordinary? Because this is the change in accounting estimate. This is the effect of change in estimate. And sir, effect of change is classified as ordinary or extraordinary depending upon the original estimate. Can I say last year's original estimate was extraordinary? So current year also this 8,000 of loss will be treated as what? An extraordinary item. Right? So this is how you have to present your answer. So let's look at the solution. I'll also show you the practical aspect, but it is not required in exam. I will also show you the practical aspect. First, have a look at the solution. What it says. The fall in the estimated NRV of the damaged stock, 8,000. Now, how did we get 8,000? Sir, 12,000 was opening NRV, right? And at the end of the year, the NRV was estimated at only 4,000. So 12 minus 4, 8,000 is the fall in the NRV, is the effect of change in accounting estimate. As per AS5, the effect of a change in accounting estimate should be classified using the same classification in the statement of profit and loss as was used for the previous estimate. So it is presumed that, now please understand, it is presumed that the loss by fire in the year ended 31st March 2012, that is the difference of cost and NRV. In my, just for the example purpose, I showed that cost was 20,000 and NRV was 12,000. So the difference of cost and NRV was last year 8,000 was shown in the profit and loss account as an extraordinary item because the loss was due to fire, and fire is extraordinary, right? So last year it is presumed that it was shown as extraordinary. So technically, therefore, in the current year 12-13, the revision in the accounting estimate. So can I say now when you revise the estimate, again, the effect of change is 8,000 rupees. This 8,000 loss should be classified as extraordinary item in the profit and loss account, and the closing stock should be shown. The closing stock should be shown excluding the value of damaged goods. And this is how you will show your closing stock. Closing stock 1,50,000, which includes damaged goods, less revised value of damaged goods, that is 4,000, and closing stock excluding damaged goods 1,46,000 at the end of the year. Right? And this is the theoretical part. Practical thing I'm showing you only for your reference. Only for your reference. See what is going to happen. I just drop this again. Only for your reference, I'm showing how it will be shown in the profit and loss account. Say, for example, this is your trading account, correct? So you will have your two opening stock. Can I say opening stock will be 12,000? These are your damaged ones. Huh? These are your damaged ones, correct? Now, these will be remaining in your books of accounts because they are not going to be sold. Now, at the end of the year, these are valued at only 4,000 rupees. So can I say the value of this 12,000 should be reduced to 4,000 only? Right. So I have to show here less reduction in NRV, 8,000 rupees, and in the outer column it will be 4,000. Correct. And this reduction will be a loss, which will be transferred to the PL account debit to reduction in NRV 8,000 rupees, and this will be debited to PNL as an extraordinary item. And this 4,000 opening balance will become closing balance at the end of the year because it is unsold. So on the trading account credit side, you will be showing like this: closing stock, normal, 1,46,000, damaged, 4,000, total 1,50,000. So you have to show the damaged separately. Right? So this is the practical aspect, but nobody is going to ask you the practical aspect in the exam. No need to show this at all. You just have to write this solution. So I'm giving this entire in one screen. So you can zoom in your mobile and write down accordingly. So please take a note of this. Yeah. I hope you have completed with question number 6 now. We will have to now move ahead. What I'll do is I'll just now please don't send any chat because I'm uploading the AS4 material now. Yes, AS4 material has been uploaded. Did you get it in the chat box? Just check it in the chat box. Please download it. And also please forward in your respective WhatsApp group of the class, because what will happen is somebody will not be able to download it. So they will give me queries, sir, I did not get the file, So of your respective batches, you please forward the file in your WhatsApp also. See, one are not able to download. Anybody has downloaded? See, it hasn't come yet because it is a common point. Has anybody downloaded and opened the file? Please raise a hand. Okay, yes. So please forward it in your respective WhatsApp groups. Yes, Preeti. Achha, you raised the hand for you received it. Okay. So please forward it in a respective class WhatsApp group also so that everybody will get it. Four and five solution together. Please take the screenshot. It is AS1 question 3. We did it yesterday evening only. Question number 2. Question 2. Question 2 done. Ordinary extra. These are already available on the web, Ray. Why do you want to take a screenshot of this? Okay, take it. This is one full page. Take a screenshot and then zoom it. This is full page of ordinary, extraordinary, and prior period items. Right? Let us go ahead now.